Ladies and gents, welcome to the Landlord Page podcast, and thanks for checking in on this week's episode with Scott. Now, Scott is a mortgage advisor, he's a property investor, he's a very, very switched on gentleman with a lot of property experience. I've got him on this week because I want to find out exactly why he bought 3 buy-to-lets in Lincoln, and as a mortgage advisor himself, how he's finding the trends and the shifts within the market over the last couple of months.
I think it comes down to people's risk averse and how risky they want to be, especially depending on what their plans are with their own personal life, and if they're moving home, if they're starting a family, if they're recently going self-employed. So it depends what they're doing at the time.
Yeah.
But my attitude is, as long as the property's not losing me money, then it's a good investment, because statistically it's going to go up anywhere from 3 to 5% year on year. Obviously, I know we're in a slightly different situation at the moment because the property prices have just massively gone up over the last 5-10 years, even the last 2 years, right, with everything that's gone on. But then if you keep hold of the property, it will eventually sort of go back up to where you need it to be.
Scott owns SWS Financial. He's been in the mortgage game for 4+ years, and his business started just inside 1 year ago. So great guy. Going to be asking him all sorts of questions, but I'm first going to kick off this episode and find out, for someone that lives in the south of England, why did he buy his first 3 property investments for his portfolio in Lincoln? Let's find out. Let's get him in. Scott, thank you for joining me on the podcast today.
No worries.
I'm really excited. We've got someone in the room finally that's a mortgage advisor, understanding the market, property, but also a property investor yourself. So we've got a lot to cover today.
Yeah, we've got a lot to cover, a lot to catch up on as well. So thank you for inviting me down.
Yeah, very welcome, very welcome. So the first thing, let's start on the buy-to-lets. Okay, and what I'm interested to know is how someone's mindset goes into, I'm now going to buy a property and use it as an asset rather than use it as a property to live in.
Yeah.
So it's very topical and relevant to obviously this particular podcast. But what was that process in your head? Why did you think it was a good idea, and why did you end up going through with it?
Yeah, it's a really good question. I think everyone's got a slightly different answer to this, because it comes down to what your personal goals are, aspirations, and what you're interested in as well. So my decision came down to, I was always interested in property. So I started as an estate agent at 18 and did that for about 4 years or so, and really enjoyed it. So always been passionate about property, and then I went into mortgages. But in terms of the property investor myself, I am very keen on having financial freedom in the future, but also being able to decide when I want to retire, as opposed to state retirement age at 68 or whatever it may be.
Yeah.
And I felt that property is probably one of the best ways to create financial freedom, to have a passive income, and you get capital growth as well. And being in the UK, especially in the south where we are, we always see capital growth. And I think statistically every 15 to 20 years, properties are doubling.
Yeah.
But as I said, you get the passive income as well. So I said to myself, after I got my first home, which I've had for about 4 years now, I've always wanted to get into buy-to-lets because it's a good investment. But then obviously on the flip side, you've got pensions as well. So I worked out what was best for me at that time. And I decided that I wanted to jump into buy-to-lets.
So you kind of, I guess, casting the web, putting eggs in different baskets, and you've got your business, you've got your pension planning, and then you've got your property planning as well, and anything else that comes along down the line, just trying to build some revenue streams. I think the pension planning is probably something that a lot of people do. I know with my buy-to-lets, my idea was to have the mortgages paid off by the time I turned 50. That was my ultimate goal when I purchased them. So when I said to the broker at the time, right, I need this one on a 19-year mortgage, the last one that I'd bought, and he was like, what? I was like, okay, well, I'm 31. I want it paid off by the time I turn 50.
Was this a buy-to-let?
Yeah. So we did that on a repayment plan for 19 years. And I think there's 11 years left on that particular one now. So that was my thought process. It was always about long-term. I didn't really worry about making any money monthly, as long as it sort of washed face. I think there might be people that have bought buy-to-lets in the record low mortgage rates, sub 1% type stuff, that maybe their fixed terms are going to come up in 2 years' time. With your mortgage advisor hat, are you worried that maybe some of those landlords might sort of almost go from breaking even or making a little bit of profit to potentially the other?
Yeah, and all three. And I've had a few clients recently, a couple of good friends of mine that have had their buy-to-let products come to an end, which they fixed either 5 years ago, so about 4.5 years. You can now start the remortgage process, or 2 years ago, where, as you said, the base rate was 0.1, so pretty much nothing. And the buy-to-let products were probably anywhere from early ones to about 2%. And over the last 7 or 8 months, in some cases, they've tripled. I've got a friend of mine, for example, he's got a property in Bracknell. His mortgage payment's gone from £330 to £1,100 on interest only.
What's the rent?
And the rent has just been increased from £1,150 to £1,300. So he's just making a profit.
Yeah.
But once you take out agency fees, tax, insurance, and everything else, bit of maintenance, it's just washing its face. Yeah. But then the argument to that is you've still got the capital growth. And if the property is paying for itself, then that's fine. Because if you did decide to sell it, you're going to have to pay capital gains tax, you're going to have to pay estate agency fees, and everything else that comes with that. So I think people have got a lot of difficult decisions to make at the moment. But I think it also depends where they are in life. So if they're at sort of the younger stage and they want to invest and sort of keep growing their portfolio, then they're fine with it. But if you're probably in the older part of your life and you're sort of thinking about your retirement more, then some people are definitely coming out the market for sure.
It's a funny one, isn't it? Because when we look at it that way and you think, okay, that property is washing face, some people will turn their nose up at that. But actually, when you think about it in property investing, I always look at property investing's biggest rival is the stock market.
Sure.
And people invest in the stock market, but they don't invest and get a return. Obviously, some are set up on dividends and stuff, but you don't invest monthly in a loan and get a return on it.
Yeah.
You just put money in there and you hope that the stock market or your stock improves.
Yeah.
That's the gamble. But with property, it's very much the same. Even if I was losing £50, £100 a month, but my mortgage is being paid off, my tenant's still paying the bulk of my £800 a month mortgage, or in your friend's case, 1,100. That's not a bad thing as long as the property is going up in time. And there's obviously dips and things in the market, but it is a funny way that we look at property investing sometimes.
Yeah, it's a really funny way. And I think it comes down to people's risk averse and how risky they want to be. Especially depending on what their plans are with their own personal life, and if they're moving home, if they're starting a family, if they're recently going self-employed. So it depends what they're doing at the time.
Yeah.
But my attitude is, as long as the property's not losing me money, then it's a good investment, because statistically it's going to go up anywhere from 3 to 5% year on year. Obviously, I know we're in a slightly different situation at the moment because the property prices have just massively gone up over the last 5-10 years, even the last 2 years, right, with everything that's gone on. But then if you keep hold of the property, it will eventually sort of go back up to where you need it to be.
So with the journey that you went on, with obviously former estate agent, mortgage advisor, property owner, planning for the future, not everyone does at a young age. Sometimes people get too later in life and they go, right, I better plan for the future.
It's too late.
You're kind of 55 or whatever, and you can still make that work. But if you do it at a much younger age, then the win is obviously going to be more significant. What was the process in terms of how you selected the region you ended up investing, and sort of how did that come about?
Yeah, that's a really good question. It's something that I still haven't totally decided on in terms of where's the best area, but I always feel that you need to invest in a few different areas to spread your risk. But I initially looked in Liverpool, we looked in Birmingham, and then we looked in sort of the northeast a little bit as well, and then decided to buy in Lincoln. And the main reason for that is a really good student town. The properties are a fair value, and the rental yield's quite high. Went up to Lincoln for the day, saw a couple of properties, and we thought they were quite a good opportunity because there was two we actually bought down the same road, being sold by the same owner.
Okay.
So we thought that we should be able to get a reasonably good deal if we bought both of them.
Yeah.
So decided in Lincoln at the end, and mainly I looked in Lincoln to start with because a friend of mine has a couple of properties there and they've been quite successful with their rentals there. So I think
there was a case study of evidence that you sort of followed, which I think that's quite common. You either invest locally where you know, or you kind of follow someone else's success. Success leaves trails, doesn't it?
Yeah. But I think it's really difficult to decide where to invest. One, especially if you don't know the areas. If it's more than an hour away, you're probably not going to know the area at all. But then also, what type of properties do you go for? whether it's just a single let house or flat, HMO, multi-unit block, whatever it may be. It's then deciding on the area, but then also the type of properties that you want to go for.
What type was it that you bought? Was it a house?
So I've got 3 in Lincoln,
Okay.
completed them, 2 in October, and then 1 at the end of January just gone, and they are all 4-bedroom HMOs.
Okay.
2 rented to students, and then 1 rented to professionals. In hindsight now, I would probably have spread the risk a little bit more, because with COVID and everything that's happened over the last 2.5, 3 years, there's been a lot of students that haven't made the big friendship groups where they have done in previous years, because they've either been at home or whatever it may be, and they haven't been going out as much. So they have found that the 2 and 3 bedrooms have been more popular compared to the 4, 5, 6 beds compared to previous years.
Yeah, because before you would probably find one person would almost go out and find the property, and then the other 3, 4, 5 would follow.
Yeah.
But now, obviously, if the circle is much smaller,
Mm-hmm.
or if you're on your own, I guess, and going into new sort of uni, then that's the challenge. Yeah,
Mm-hmm.
it's interesting. So the 4 beds have been hard to fill one of the rooms, have they? Or
yes, we've rented them out on like 1 AST, so 1 rental agreement. We've got 1 that's rented for the next academic year, so 23, 24. So our current tenancy ends in June, and then it starts again in August. So we get about sort of 4 weeks to do any repairs or anything like that. And then the other property, we've had quite a lot of interest on it, but for one reason or another, we haven't had an offer yet. But we've got a couple more viewings over the next few days or so. So hopefully that gets rented. If not, obviously looking at the price, potentially looking to switch it to professionals, and or worst case, it's to switch it to a family home.
Yeah.
So that's a good thing about when you're looking at HMO properties. You've always got options to rent it out a different way, worst case scenario.
Yeah, you can fall back and take less of a yield, but have security of the family. And
again, it falls back to as long as it doesn't cost you money.
Yeah, exactly. As long as your finances are set up, that you've got the fallback worst case scenario option, which I'm sure as a mortgage advisor you did.
Yes, I did. Yes, heavily. Yeah.
What's the price of a 4-bed up there? What was the cheapest one you bought?
So we got the 2 that were being sold by the same owner at 190. Each.
Yeah.
And then the other one was, so we initially bought it, offer accepted at 181, because we were bidding with someone else. Initially went at 180, 181, secured it, got down valued to 168.
Right.
Seller wasn't willing to take that and wanted us to meet them in the middle. And at the time, it was when interest rates were going up, buy-to-let products were being pulled, or all products were being pulled at the time. So we knew that we had that to our advantage. And if they didn't negotiate with us, they probably wouldn't have sold the property.
Yeah.
So we said, look, we're not willing to offer any more than the 168, which is what it's valued at. And they said, look, we're not taking that. So we left it there. They put it back on the market. I think they probably had some viewings, but no better offers than that. And then I think 4 or 5 weeks later, I contacted the agent because I saw it still available. And they said, would they be willing to accept an offer now? And we got accepted at 162.
Wow, even lower.
So nearly, 19,000 less than what we agreed at 2 or 3 months before.
From your point of view, as an investor, it just shows patience, logic, not acting on emotion is a big difference, because that's had a massive difference to obviously the equity gain on that one as well over the next 10, 20 years, however long you own it. So, that's a huge win there.
And I think that massively comes down to why you're buying the property, because as you said, there's no really emotion involved. It's not a house that I'm going to move into or ever go into. So as long as the numbers work, it's a good opportunity. But then on the flip side, if you look at it from a family home, if you're buying it, then you might have found the money another way.
Yeah.
But I think the advice that I give to my clients as investors is, as long as the numbers work and you think this is a property that will be a good investment long term, go for it.
Yeah, I think I'm writing a guide at the moment for home movers, in particular more families that are looking to sell and buy. And one of the things that I put in there is about looking at your best and worst case scenario and going to a mortgage consultation with an advisor and asking best and worst case scenario. Worst case scenario, if I sold my property that's worth 440 for 415, and best case scenario, if I got the 440, what does that look like in terms of what I can achieve and what I can get? Because where most home movers, more in residential than investment, where most homeowners go wrong is they get a valuation, they tell the mortgage advisor that's what they're going to achieve. The mortgage advisor writes that down. They run the numbers on getting that. They go to the market, and 10 weeks later, they've got 25 grand less deposit for the next purchase, and they can't get the house with the extra ensuite or with the extra bedroom that they wanted, or the garage on the side, it's integral, whatever. And it ruins the dream a little bit.
Yeah, it definitely does. And I always, on the initial call with clients, if they're sellers, of course, and they're moving home, I always ask them, what's the valuation they've had from an estate agent? That's usually going to be what it's going to go on the market for. And it might be a little bit less, obviously, depending on what market we're in. Maybe a year ago, then you'll get that if not over, more, right? But now things are slightly different. So especially if clients that either all their equity is going towards the deposit, stamp duty, legal fees, and everything like that, compared to some clients who have money in savings. If their cost of moving is coming from equity, then it's a slightly different conversation because they've got the savings in the bank to potentially help out there. But I'm really careful with clients these days if they're tight on affordability or not have much cash in the bank.
It's so important because we've digressed from property investing, but just to general property here. But it's so important for people that are moving home, for people that are involved in the middle, the solicitor, the mortgage advisor, the estate agent, the bank or surveyor, everyone involved have to understand that the goal of someone that's selling a home, they're not selling a home because they want to sell a home. They're selling it because they need to finance the goal, which the goal is the change of area, the upsize, the downsize, whatever it may be, the features of the new property. And that's the ultimate tick box for that particular client. And sometimes we get caught up in the transactional part of the middle bit, and it's really important to think about it. So let's talk about you as a mortgage advisor. You've been mortgage advising for quite a few years now, and you've actually just started your own business, which I mentioned on the intro, SWS Financial. How's that going? Challenging time, obviously, around mini budget. You must have launched around mini budget.
So I launched in last summer. It's been a crazy last 8 or 9 months or so. It's crazy how quickly the time's gone. It's been good because I've been mortgage broker now for 4 years in total. About 8 months originally employed, and then self-employed before that, and then set up my own business. So I was kind of running my own business before launching it in my own company name, should we say? I found the market has been really good. I think it's been challenging. I think there's been a lot of changes, especially with interest rates and people being concerned about property values going down, interest rates going up, cost of living as well, which has taken a massive effect on that. But I think that things have got a lot better since the interest rates started to rise 6 months ago or so, because ever since, I would say, October, November, the rates have started to come down. Surprisingly, even though the base rate's gone up, interest rates, especially obviously the fixed products, have come down. And a lot of them are from sort of the high street banks. Which
I had a couple of our agents actually on that point. They messaged me and said, how is the base rate 4 and the mortgage rates starting with a 3? How is that even possible? And not everyone understands that obviously the base rate has an impact on setting the tone for the interest rate, but inevitably it's the swap rates, right, that have the impact. Could you give us a little bit of explanation around that for someone that doesn't understand that's where the rates kind of get set from?
Yeah, so it all depends on how much the bank is being charged to borrow that money so then they can lend it out to their customers. But ultimately, I think when the fixed rates are being launched, and in terms of like their new products that are coming out, I think they knew the base rate. Everyone knew the base rate was going to be changing because I think they predicted it was going to be around 5.2, so early fives, and now they're probably expecting it to settle around 4.25, 4.5, and we're at 4 now. So I think a lot of the lenders that were looking at their fixed products over the last couple of months have taken into consideration that the base rate was going to rise. It's surprising that the fixed rates are so attractive at the moment. So went to a couple of clients yesterday, and the fixed rates are some just above base rate, which is surprising for a lot of people considering what's happened over the last 7 or 8 months or so. It's interesting to see what lenders are doing and sort of how products are at the moment, and things are changing constantly. So what's available today might not be available in a few days' time, or certainly not in a couple of weeks.
Because these products, they get dipped into the market. There's a bit clickbait involved.
Of course there is. Yeah.
HSBC are the worst for it. I don't know whether you can say that, but I can. They're the worst for the clickbait kind of, this is the headline mortgage, and they might release like 50 of them that day and no one's getting them or whatever it may be. But what I'm interested to talk about is the 5-year money seems to be the best and the cheapest deals at the moment, or it has been the last couple of months. So why is it that a bank wants a client to engage in a cheaper interest rate for 5 years compared to the same property they may be purchasing or remortgaging for 2-year money? What's the logic that's going through the bank's mind in that situation?
Yeah, it's a really good question. I think, obviously, being in mortgages for 4 years or so, I've only seen interest rates being really low, right?
Yeah.
And I think that with the 2 years and the 5-year fixed comparison, the 2 years have always been cheaper.
Yeah,
because it's a lower risk, right? But then with the 5 years now being cheaper than the 2 years, and pretty much every lender, and it's been on the same like that for quite a while now. I think it mainly comes down to lenders probably know that the Bank of England base rate isn't going to be this high for this long, and they know that they're trying to get customers tied into 5-year products, and the way they can entice people to do that is by offering them cheaper deals, because in some cases it could be a saving of, obviously depending on how big your mortgage is and what term, it could be a saving of a few £100 a month. So a lot of clients, although it's probably starts with an early 4 or mid 4 for a 5-year fix, which over the last 10 years is high, but considering what we've been through the last 7 or 8 months, it's reasonably low. And I think if people are comfortable with that payment, then they're choosing the 5-year fix as opposed to the 2. Because again, there's still a little bit of uncertainty what's going to happen over the next 12 to 24 months.
I think people if they could set that up with their bills, if they could pay X amount of money on their water, their gas, their electric, their fuel, whatever it may be, their shopping, all of these things, if they could just have flat rates, they'd pay a little bit extra just to know that that's me locked in for the next 3 years, calculate where they need to be. Okay, so I've got X amount of money at the end of the month spare or free, or this is where I'm going to sit. People want that kind of security, don't they? Really? Is that why you think, I mean, I don't know what the percentage split is, that, and maybe you've got a rough idea for your clients, but tracker versus fixed, I would say 80%, 90% normally is fixed. Is that the same mindset?
Yeah, so in the last sort of 6 months or so, I've done more trackers than I have in 4 years of being a mortgage broker. And I think that mainly comes down to the trackers being, in a lot of cases, a lot cheaper than fixed. And we're talking anywhere from 1 to even 2% in some cases, whether the fixed products went up. Some were high 5s, early 6s, where the trackers were sort of 4 to mid 4s. So it made a massive difference to clients' monthly payments. And a lot of tracker products, especially with the high street lenders, they come with no early repayment charge. Therefore, how I was positioning it to the clients, I usually always give them options in terms of, these are the products that are available at the moment: tracker, 2-year, 5-year, and then sort of discuss them in more detail. But a lot of the trackers, especially from the high street lenders, they've come with no early repayment charge. So if clients were saving a couple of £100 a month on a tracker, but were a little bit risk adverse and didn't want to sit on that for too long, we could sort of monitor the market to sort of see what the fixed rate products were doing. And if they started to come down, or if the clients were moving, because a lot of clients are looking to move as well, so it gives them flexibility, then we can move over to a fixed product with no early repayment charge at all. There's usually an admin fee of anywhere from £30 to £50. But for the sake of having complete flexibility, a lot of people are choosing trackers. But there's now a lot of people. So I recently emailed all my clients that I did trackers for over the last 6 months to arrange appointments with them to give them an update on what the market's doing and whether they're either looking to move or whether they're looking to move over to a fix, because they're now more attractive.
I think it's really important. I've almost got in my head, if I was a broker, thinking these are all my tracker clients, and I've almost got them on a traffic light system to say these are green, they're good, they're on those good trackers, that's fine. Even if it goes to 4.5, they're absolutely fine. These are kind of sat in amber. If it goes up again, we need to have a chat. And now it's gone up to 4. These red ones probably need to be flipping over. And having a broker that looks after you in that way as a client, I think, is value for life, really, isn't it?
Yeah. Oh, definitely. And that's one of the main reasons I set up my own business, because I felt there's a gap in the market for sort of giving sound advice and making sure clients were fully updated throughout the whole process, not just doing their first mortgage and locking that in and speak to you in 2 or 5 years, but just continuously keeping them updated throughout the process, especially on products. Even this morning, I quoted a client for Barclays, to give you an example. So a 2-year fix was 4.3 and the tracker was 4.36.
Wow.
So it makes sense going for the fixed, right?
It's not going down anytime soon, is it?
No, it's not going down.
Yeah.
It's potentially going to get worse
Yeah.
before it gets better. So for a lot of people at the moment, considering whether to go for a fixed or a tracker, it does depend on the type of loan you've got, the loan to value, the term, and whether you're thinking of moving, because obviously you don't really want to tie into a lender if you're thinking of moving later this year, depending on your situation, because you can port mortgages. But yeah, I think it's crazy how much things have changed over the last 6 months.
People try and time the market, and
it's impossible.
It's so difficult. I mean, we mentioned 10 minutes ago that the base rate was 0.1%.
So pretty much nothing, right?
It's absolutely
the lowest
insane.
It's ever been.
And you think, well, no one's going on a tracker at that point because it's not going down.
No.
It's only going up. But then for me personally, my residential remortgage is due May next year.
Mm-hmm.
So I'm one of those guys that I did a 3-year and I nearly did the 5 and I should have done the 5 and I didn't.
Hindsight's a wonderful
Hindsight
thing,
is a bitch. But that happened. So in my head, I'm now thinking, well, if base rate tops out at 4.25, which is personally where I think it may do, and that happens somewhere before summer of this year, I've almost got 10 months before remortgage. And as long as things are feeling a bit more secure and a bit more level, my thought is that probably around the time that I'm looking to remortgage, within the next 6 months, we might see that base rate creeping back down. And if I was to go on record, and I'm being filmed and recorded, so I effectively am, I would think that it will be 3.25, 3.5, maybe even 3 by the end of next year.
The base rate?
The base rate,
yeah.
That would be my gut in terms of...
Should we write that down?
There's two cameras here, so it's there. That would be what I think will probably happen. So for me, I am in that mode of, if the tracker is appealing, I think I might see the base rate dropping. Mm-hmm. So it might make sense for me on my mortgage to go with a tracker and reap the benefits.
Yeah.
But it's a long way away. It's a year away, and who knows what the market will bring. Timing the market.
Yeah. It's very difficult to time the market for mortgages and interest rates, but also moving. You know, there's been a lot of people that have said to me, with their clients, friends, or people you just meet in the street, right, that are saying that property markets go crash. They've been saying that for 5 years.
Yeah.
Nothing's really changed in the last 4.5 years. Mm-hmm. Over the last 6 months, there's been a lot of changes. I'm sure you have sort of looked at all the stats in terms of property pricing, sale agreed, and everything else. I think it's settled. It might be on a slight downturn.
Yeah, I mean, the stats for the first 6 weeks of 2023 is pretty simple in terms of where we were last year, freak market.
Yeah.
But, start of 2022, there was about half the amount of properties, 60% of the amount of properties coming to the market in comparison to the amount that were selling.
Okay.
So we had a huge pendulum shift in terms of more sales being agreed to listings, which is unheard of for the start of the year market, because you'd normally find Christmas has happened. You've got all of the first-time buyers coming together to buy the cheaper properties. You've got all of the divorces and splits after Christmas. It just happens. Normally 2 in 3 valuations for a family home is because of a split after Christmas. Apparently families hate each other.
You've got the 3 Ds for selling, right? You've got death, divorce, and debt, right?
And this happens, and you normally find more listings. But last year it was the opposite. Well, this year it's just gone back to normal.
Yeah.
There's about 150% of properties coming to the market to what's selling.
Yeah.
So that's normal at this time. And the most in-demand properties, the actual average house price of sales achieved to listed after 4 weeks of 2023 was around 420 average house price listed and around 320 sold.
Okay.
So it's not that there's 100k swing. It's just that there's more younger buyers, first-time buyers buying, and that's so normal for the market. So it feels, for me, someone that's done it 20 years, as normal as it's felt for the last 5 years.
Yeah. Well, I think when you say normal as well, I think the last 2.5 years haven't been normal.
Absolutely not.
So I kind of think statistically wise, we're probably similar to what it was pandemic. Would that be fair to say?
Yeah.
In terms of the housing market. And yeah, I've noticed that there's been a lot more first-time buyers that are coming to the market. And I think one of the reasons for that was a couple of reasons, but I think one of the most important ones is the first-time buyers they've got nothing to compare it to.
Mm-hmm.
So for them, it's new. The property prices are what they are. They've got nothing to compare prices to.
Yep.
But also interest rates. If I tell a first-time buyer, your interest rate is going to be 4.5%, 5%. They're like, okay, no worries. As long as it fits within their affordability, and obviously we can increase term. Now we can go 35. Some lenders even do 40 years. As long as it fits within their budget, it doesn't really matter too much what the interest rate is, as long as they can afford it, because they're most likely going to be there long term. It's their residential home. It's most likely going to be cheaper than renting. I could always say that the last 10 years, maybe not now.
Well, no, rental prices are going crazy.
But rental prices have gone crazy as well. But it's difficult for landlords. I know we're specifically talking about landlords at the start of this call, but I think for landlords where their interest rates in some cases have gone up 3 to 4 times, rent hasn't gone up 4 times. No. It's gone up 15, 20%, but it hasn't gone up 4 times, of course. So I think it's been really difficult, changing the subject slightly, for landlords, especially with interest rates and deciding what to do with products, whether to keep the property, whether to go on trackers 2 year, 5 years, because they have to ensure that they're not losing money every month.
That's why we on this podcast, we really embrace the family homes. We really think it's worth being patient. And unless you've got a leasehold absolute chop out bargain or a fixer upper or something that's just a no-brainer good asset to purchase, going for a 3-bed semi-detached house or a 3-bed terrace or a 4-bed, property, it is the no-brainer, because even if, as we're talking about rents and mortgages, it deviates month by month, in the long term, that asset grows better. The family homes are the last to go down and the first to go up. So the equity should counter-strip any issues you have with the rent in reality. And I think even if we think about the craziness that we had for lockdown, COVID, housing minister, stamp duty holiday, up to 15 grand saved on tax. Then we've had the whole kind of mini budget hand grenade, and mortgages for the first time since I can ever think of were just not available. It was like we just had that week, didn't we? It was like, oh, what do we do?
Yeah. And so much uncertainty in that couple of weeks. Yeah.
And even 3 years prior to COVID, we had the whole Brexit catastrophe. So that was kind of causing the market to do what it's doing. So we've not really seen a normal market for a long time.
No.
It feels as normal as I felt it for the last 5 years at the moment.
Yeah. And that's the thing, it's always changing as well. But for people that are new into the industry, it's a very difficult timing, because it's been, the last 3 years have been so good for people buying properties, especially investment properties, because the interest rates have been really low. But I think now it's getting a little bit harder. So there's a lot more people competing for business. But also, especially with the buy-to-lets, it's slowed down. And the main reason for that is because of the interest rates. Because especially properties down here in the south, where you're probably getting anywhere from 4 to 6% yield, if your interest rate is 5 or 6, you're unfortunately losing money every month, but then the lenders wouldn't lend you the money if it didn't meet their stress test. So I think there's been a lot of people that haven't bought buy-to-let properties over the last 6 months, which would have done, especially in the south. But I think now interest rates are coming down. People know their money is going down with inflation in the bank. So they want to invest in property. So I think moving forward into the year, as rates hopefully still continue to come down for the buy-to-let market, there'll be more and more landlords that are looking to expand their portfolio, or even first-time landlords that are looking to get their first investment.
Yeah, I think there'll be a lot of business owners. I mean, I talked to a lot of business owners that are JVing, joint venturing with another business owner for strength in numbers and security. When you were talking about your buy-to-lets, you were saying so something similar to what you've done probably. And I think there's a couple of things. I mean, I'm going to go rogue at the end of this podcast now, but there's a couple of things that people don't bear in mind, especially for property investing with the market. AI is now crazy in the marketing space, but the programs that are being created through Microsoft for AI, we're only a month, 2 months, less than a year away from AI being able to effectively spit out the data that property investors have been crying out for, because AI can do that. It can go and troll Rightmove and say, these have been on the market for X amount of time. They can search the owner, the land registry. They can find out who's got debt, mortgage, who's had babies, who's got car
Mm-hmm.
finances, and they can spit out and say, this is your top 10 hit list properties across the country.
Mm-hmm.
AI can do that. We couldn't do that, but AI can do that.
We could, but it would take hours.
It would take ages to do thousands of properties. AI can do it in 30 seconds.
Yeah.
So once that program's built, that's going to make a massive change, because you've got an investing guide and blueprint that's sourced through the use of artificial intelligence, which is crazy, but it's there. And then you've also got the element of blockchain just pushing hard to be involved in the property transaction, whether that's communicating mortgage offers with solicitors and surveyors and estate agents and clients all at the same time to speed it up, or whether it's facilitating some sort of finance element of things and almost removing banks from the equation potentially into funding and things like that. So there's two way rogue conversations there for another time, but they will come into the property market. And when they do, it will be like a stamp duty holiday, because it gives people other options to go and purchase property that they couldn't have done before, basically. So.
Definitely. And I think at the moment, especially in the news, there's been a lot of doom and gloom with interest rates and property prices falling. And it depends who you talk to, right? It depends where they are in their life and whether they're a business owner or have got buy-to-lets or looking to invest money in property. A lot of the news is that property prices are going to fall. But with interest rates still continue to go down, I think obviously there's more schemes that are helping first-time buyers to get onto the ladder. There's been the slight incentive for stamp duty that changed in September last year, I believe it was, that are now saving roughly £1,500 on every investment you buy, or even if you're moving home. But I genuinely think that there might be a rise in property prices this year, dependent on what happens. Because at the end of the day, it depends what property you buy as well. If you're an investor that is looking to buy a property in really good condition and rent out straight away, then that may not see an increase in value over the next 12 to 24 months. But if you're buying a property that's maybe a repossession, it's a probate, the person's got really bad debt and they need to get rid of the property quickly, if you can get it below market value for a good price and improve the property, whether that's by renovating it, doing an extension, changing it from a 4-bedroom house to a HMO, that property's probably going to go up in value maybe 15 to 20% just by you doing your improvements. And if you're looking to keep hold of that house long term, then it's a good investment for you. There's a lot of properties that I've seen personally, as obviously looking to invest in more property this year, that you can get. There's more properties coming to the market that are repossessions, or that are probates, or properties that are really run down that sellers are taking offers for, especially if they're motivated, where this time 12 months ago you wouldn't be able to maybe get it below 5-10% less than what you maybe can now.
I mean, I've seen north of the Birmingham border, as we call it down south, there is auction galore going on up there as well. So it's a crazy time. And I think if we think about, it's quite an interesting subject that you mentioned there. You think property prices could go up this year. I think some areas and some types of properties, we could very easily see that. And if I was to pin it in where, in the south, looking at 2-bedroom houses, I would expect, if I was to put a pin on anything that could go up in value, it would be them, because tenants can't find anything. It's very expensive. The bank of mum and dad, I saw some mental stat. You might have seen it. I think it was a Mortgage Press about what the bank of mum and dad lend across I think it was the globe rather than the UK. It was something stupid like 20 trillion or something mental like that. That's there as an opportunity for first-time buyers to come out of the rental market, because it's unaffordable, it's unachievable to find, and go into property. Scott, we could talk all day about this, and I think we'll probably have another chat maybe in sort of 4 or 5 months' time and see how many of our forecasting that we've done today. We've gone brave on the camera today with forecasting and have another chat. But it's been awesome to have someone that's able to put their investment hat on, their buy-to-let hat on, that's gone a little bit out of area as well and done something different to what a lot of people do for their first investing, which is normally investing locally, but also have a mortgage advisor on that clearly knows their stuff. So in the show notes, if you're listening, you've got all of Scott's details, his website, his contact information, if you want to have a chat with him and get in contact. where are you putting out most of your messages at the moment? Is there a particular platform that people can come and hear more about you?
Yeah, so most of my messages at the moment are just going out to my existing clients or clients that I've got on my database that I've spoken to over the last few years or so, that are either landlords or people that are thinking of moving, to do a lot of sort of marketing for them. And then looking to sort of increase my social media this year. But no, it's been really good coming on, Ian. Appreciate your time, and look forward to sort of seeing what our predictions are like in a few months' time.
Yeah, absolutely. So yeah, if you want to be part of that kind of exclusive email list of Scott's, then let us know in the show notes. We can get that sorted out, and you can obviously get that updated information. It's nice that you've kind of got that to your clients, because it means it's more authentic, the information. So,
and there's a lot of changes at the moment. So as I said earlier, with the clients that are on trackers, so I'm constantly sort of monitoring what their products are on, what the fixed rates are. So there's clients that I'm sure are worried about what interest rates are going to do, but they're constantly getting sort of email updates from me. I think it just either gives them reassurance, or it knows that they can give me a call to discuss their options in more detail. But I think one of the things you mentioned a moment ago, which is, I think, massively helps me win business, but also helps my clients feel sure that they've chosen the right mortgage broker, is by me being in the industry myself, being an estate agent at one point, but also being a property investor. Now, I have to give my professional advice on mortgages and mortgage products and regulations, but I also give my personal advice on whether I think the property or the area is a good investment as well.
Love that. Thank you, Scott. Thank you for your time.
All right. Thanks, Ian. Appreciate it.
So, ladies and gents, it was just me for this one, and it was a blast, actually. A long episode with Scott, but it absolutely flew by. And I think, first of all, what a switched on and educated, experienced property professional. To get a mortgage advisor on that's also a very active buy-to-let landlord is a really nice blend, because it shows confidence in the market, but it also shows they can practice what they preach. So as a mortgage advisor, it was really interesting, I found, on this particular episode, talking about the fixed and the tracker trends and what's been going on there. I thought that was fantastic and insightful. Apologies if I went rogue with the AI question and discussion, but I feel quite passionate about that. I think that's something that's going to have an impact in the property market, either in the next couple of years or maybe inside the next decade. It's definitely coming. It's going to have a positive impact. And also hearing about his story of how he's tried to set himself up with pension planning, a residential property, his buy-to-lets, and his business, and how he's really looking at someone that's in their mid-20s that's got his head switched on very, very well in how he looks at future-proofing his life and becoming financially free, as he said. So it's a cracking episode. Thank you for checking in. As I said at the end of that conversation with Scott, show notes is where you're going to find all his details. If you've got any questions for me, you know where I am. And next week, we've got an absolute corker for you. So if you haven't already subscribed, please make sure you subscribe to the channel so you get the notification when the next week's episode drops on Friday. Have a good rest of the week, everyone. I'm flicking through YouTube and through Spotify. I don't think there's a podcast or a video channel on YouTube that landlords could land on where they're not being sold something.
I mean, it'd be the first time any estate agents ever asked that question, but why not ask that question to a wider audience?
Estate agents have the knowledge there, but they don't seem to share it.
You can do different episodes based around someone that wants an exit plan or someone that's just starting their portfolio.
The rules change every year.
Yeah.
But why not just open the floor out and just say, well, is property even the best investment out there?
And tax advice is a big thing, especially with everything that's changed, capital gains tax, and obviously your stamp duty costs that you need to pay and whatnot. People don't realise what they need to prepare for.
We build a podcast and we build a YouTube channel, somewhere that landlords can go and they feel they're not being sold to, but they're just getting quality advice.